Welcome to the Investing Insights podcast from Morningstar.com. This podcast is brought to you by the Morningstar channel for Roku. Enjoy insightful, independent video content in your living room. Download the Morningstar channel to your Roku today. This week on the podcast, we dig into Snap and Disney earnings. Steve Wendel tells us how to keep cool when the market is not. Christine Benz shares 5 to-dos for retirees as volatility returns. PIMCO's Mihir Worah says tips and commodities look attractive. Schwab's Sonders gives her take on the market's moves. And our analysts give 2 dividend ETF picks and stocks that look attractive after the energy sell-off. So let's get started. Here's our take on Snap and Disney earnings. Shares of Snap soared this morning after the firm finally reported a strong quarter as a public company. With some improvement in user growth and further automation of sales of Snap ads, we think the firm is slowly making headway toward providing a scalable and easily measurable platform. However, given Snap's continuing difficulty to further accelerate user growth, we remain convinced the firm lacks a network effect moat source. We see the shares as fairly valued today. Disney shares, on the other hand, were up only modestly after the media giant posted in-line results. The parks and resorts business saw strong 13% growth, as even Disneyland Paris contributed to growth, helping drive overall revenue growth of 3%. Management also disclosed that the regulatory process for the Fox deal has begun. We see shares of the wide moat firm as attractive today. We're planning a modest decrease to our fair value for Chipotle after the firm's fourth quarter results, which sent shares sharply lower. The company remains in transition, and its fourth quarter update offered a few hints of stabilization that were overshadowed by unknowns. We're reducing our long-term margin assumptions, but that is offset by a lower tax rate and other adjustments. Shares are undervalued, but we'd recommend investors wait for a larger margin of safety before investing.
Overwhelmed by the market? Morningstar Premium will help you cut through the noise and find the most promising investments. Get started today with Morningstar Premium.
Now, Steve Wendel tells us how to keep cool when the market is not.
For Morningstar, I'm Jeremy Glazer. With major indexes down over 4% today, it seemed like an opportune time to sit down with Steve Wendel. He's our head of behavioral sciences at Morningstar, with some ideas about how to keep your cool when the market isn't. Steve, thanks for joining me.
Thanks for having me.
We all know the advice is generally don't look at your portfolio when you have a day like this, but that's really hard to do, right? Is that something we could reasonably expect investors not to check their portfolio when you see this much volatility?
Sure. So first, that is good advice. There's lots of research on how frequently checking your portfolio, and especially during market downturns, can warp one's behavior and get you into trouble. But we're all human. I've been looking at my portfolio as well throughout the day, just out of curiosity. And so thankfully, there are a variety of things we can do to help us calm down and get back to our rational selves.
So what are some of those strategies?
Yeah, of course. So a variety of great techniques you can use. So the first one is to remember that our minds play tricks on us. That fundamentally volatility, downward or upward, is just data. And as for the drop that just happened, that's past, that's gone. There's nothing we can do about what just happened. It's really as we think forward to what will happen that our minds take that data and apply a story. And if you don't know what that story is, it's probably the bias of recency bias, thinking that what just happened is about to happen. But when we think about that rationally, we of course know that's not the case. And so one of the things that we can do is to write out that story. Okay, so we have this just happened. This is what I believe is about to happen, and what's the rightful thing to do? And for most professional, thoughtful investors, they know it means you look for bargains. Same exact data, very different outcome.
Let's say that you are prepared for that, but we do see a further sell-off. You know, there's more volatility. Is there anything you can do now to kind of prepare yourself for that happening in the future? You could be looking for bargains for quite a while.
Yes, absolutely. So the number one rule is to externalize, is to get it out of your head and take your calm, thoughtful decisions now to help guide you in the future. Now, a variety of ways you can do that. One of the ways you can do that is to intentionally look for friction. So if you're working with an advisor or just with yourself, say, set a rule for yourself. I'm going to have a 3-day waiting period before I make any change. Or, for example, if you're working with an advisor, tell the advisor that they should only make a trade if you and your spouse are there. So think of ways that you can slow yourself down from making hasty decisions. Other techniques that you can use, of course, are to write out the rules you want to follow. that only if the market drops by this percent in a particular amount of time. And then you're checking those rules again and again rather than checking your portfolio and making up the story about how bad things are going to happen. Some other techniques you can use are to look at the emotional power of your investment policy statement. Look at what you wrote for yourself. Or if you haven't already written one, of course, you should do that. And write out not just what your financial goals are, but why you care, what matters to you, and how that expresses who you are. And then, in times of trouble, you look back at that and say, have fundamentally what I care about, what I value, has it changed? Probably not. It's a counterpoint to the vivid, crazy stories that can go in our heads when we see a market downturn.
And of course, it always makes sense to separate the real world and your real life versus your portfolio, particularly if you have 20, 30 years to retirement.
Exactly right. And so the challenge is, how do we fight vivid with vivid? We get these vivid images of a market crash, et cetera, but really, that's only one of the things that we can pay attention to. Think about, what does this mean for your goals? Probably not too much, and especially at the 20, 30-year horizon. What are the other things you have to do in your life? Play with your kids, help your family, work, do your job, etc. And so you balance that one vivid screaming thing over here with all the other things you have to do in your life. And it can help put things back in perspective.
Steve, thanks for your insights today.
Pleasure being here. Thanks for having me.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.
Can your portfolio weather the market? Use our premium portfolio tools to identify risks and streamline your holdings. Get started today with Morningstar Premium.
Next up, Christine Benz shares 5 to-dos for retirees as volatility returns.
For Morningstar, I'm Jeremy Glazer. With the return of equity market volatility, many retirees and those about to enter retirement are wondering what to do. I'm here with Christine Benz. She's our Director of Personal Finance with 5 to-dos for those folks. Christine, thanks for joining me.
Jeremy, great to be here.
Let's start with the first to-do, which is really to put these losses into perspective. Just take a moment to take a step back.
Yeah, it can be really scary for people who are either getting close to retirement or actively drawing upon their portfolios when the market falls off as it has recently. So I do think that taking the very long view on your portfolio is crucial. Remember that we've had a great run-up since 2009. If you were happy with where your portfolio stood at the end of 2017, well, you're kind of right back there with these recent losses factored in. So remember that. And then dialing it back even further, over the past 30 years, we've had extraordinarily strong returns from both stocks and bonds. And so remember that as well, that you've had this great tailwind and your portfolio is still probably in pretty good shape thanks to some of those forces.
The second to-do, though, is really to dive into your portfolio, check your asset allocation, and make sure that it's where you want it to be.
Right. I always say if someone's, say, under 50, don't get too caught up in terms of checking up on your portfolio's asset allocation, but it's truly important when you're retired or getting close to retirement and planning to actively draw upon your portfolio to periodically assess your portfolio's asset allocation. If you're spending from your portfolio, as you know, I'm a big believer in the bucket strategy for retirement asset allocation. So if you're spending from your portfolio, use your portfolio withdrawals to guide how much to hold in those safe asset classes. In my model bucket portfolios, I've typically carved out 2 years worth of portfolio spending in cash instruments, another 3 to 8 or 3 to 10 years worth of portfolio spending in high quality bonds. So if you haven't revisited your portfolio's asset allocation recently and you're getting close to retirement or already retired, do it now. If you've been very hands-off and say you had a 60% equity, 40% bond portfolio in 2009, well, you're 85%, 15% bonds right now, so you probably are more aggressive than you want to be.
And that leads into the third to-do, which is to check up on those liquid reserves in your high-quality bond sleeve and make sure that they really are liquid and high quality.
Right. So really poke at that high-quality bond piece or the bond piece in your portfolio. We've seen much better returns, much better yields from some of the lower quality stuff recently, so high-yield bonds, emerging markets bonds. Make sure that that isn't the complexion of your fixed income portfolio. If you're looking for something to be true ballast for your equity holdings, you want it to be high quality. You probably don't want to be taking a lot of interest rate risk at this juncture. It doesn't mean you want to be entirely short term, but you probably want to be primarily short and intermediate term with your bond portfolio, and high quality is key.
one of the things retirees and everyone may have noticed is that both bonds and stocks have sold off recently. Is that a case against using bonds for diversification, or is that more of a short-term blip?
Yeah, it's been a little peculiar, I would say, and it's probably troubling to people who have said, well, I followed the advice to hold high-quality bonds, and here they go. They've been going down right along with stocks. On that front, I would say a couple of things. One is that even though high-quality bonds have indeed gone down, the magnitude of their losses has been much less than stocks. And that's a persistent pattern that we see over market cycles. So I would bear that in mind. Secondly, I would bear in mind that over the very long term, we typically do see high-quality bonds hold up relatively well in equity market shocks. I don't see any big reason to suspect that that pattern will be different. So focus on the long view versus the losses that we've experienced in high-quality bonds on the very short-term basis.
Your fourth to-do is to take a look at your spending rate and make sure that that is also where you'd want it to be.
Right. As we've all seen our portfolios become enlarged, it's been easy to get a little bit complacent about our spending. We've all felt that wealth effect as our portfolios have enlarged. But one of the key things retirees can do to make a save when their portfolios are declining is to rein in their spending a little bit. In fact, a lot of the great research about withdrawal rates has come back to that conclusion. If you can be a little bit market sensitive, that can go a long way toward improving your portfolio sustainability over your retirement time horizon. That's not to say that you should radically cut your spending, stop doing, going to the movies or going out to dinner, but it does mean that you should be willing to rein it in a little bit if what we've started to experience in terms of market volatility proves to be something more persistent.
And finally, it's worth it to take a look at your portfolio and sweat the small stuff.
Absolutely. So also in the realm of stuff that you can control as a retiree, on the short list would be things like looking at your cash holdings and what they're yielding. If you haven't revisited that lately, one thing we've seen is that cash yields have popped up pretty nicely. So if you've been not paying attention, you maybe are stuck in some low-yielding stuff, you could do better. Watch your investment-related expenses. That's one of the best ways that I know of to improve take-home returns. So that's fund expense ratios, any advisory fees that you're paying, any other investment-related costs. See if you can't trim them. And finally, tax costs are another big area that retirees can exert some level of control over. Most retirees are pulling their assets from multiple pools of money, whether taxable assets, Roth, or tax-deferred assets. If you're not super savvy on tax matters, work with a tax advisor to strategize about where best to pull your money from on a year-to-year basis in order to improve your take-home after-tax returns.
Christine, thank you as always.
Thank you, Jeremy.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
Now PIMCO's Mihir Worah says tips and commodities look attractive.
For Morningstar, I'm Jeremy Glazer. I'm joined today by Mihir Worah. He's the CIO of Asset Allocation and Real Return and also a Managing Director at PIMCO. Mihir, thanks so much for joining me today.
It's a pleasure, Jeremy.
I wanted to start by talking about inflation, a topic that's obviously been top of mind for the market in this last week or so. Do you think that the threat of inflation is real now? Should we be worried about price levels rising?
I think price levels are going up. They have been moving up. And whether they keep moving beyond central bank targets and how central bank respond to them is a big worry for markets right now. So, we expect, core inflation in the US is running at around 1.7% year over year. We think by the end of 2018, the base case is it should get to around 2.2%, which is, right around the Fed's target. I think what the market's worried about is with inflation finally moving up towards the central bank's target, at the same time, you're getting this big fiscal boost. We're starting to see some signs of wages go up. We're starting to see inflation go up. And at the same time, you've got the big $1.5 trillion tax cut that's over 10 years. And now we're just hearing of the budget deal, which adds about another $150 billion per year to the deficit for the next couple of years. So people are concerned about what this will do at a time when inflation is already starting to move up.
What are your expectations of how aggressively central banks globally would react to this?
I think at the central banks are already on the move as they see economies healing and no need for the emergency measures that we had in place for so many years post-crisis. We know the Fed has already hiked 5 times, and expectations are for another 3 hikes this year. The Bank of England just today started guiding towards perhaps an earlier hike and a repricing of hiking expectations. So economies are healing. Central banks are taking away emergency levels of liquidity. I think at the first stage, central banks have told us that they will accommodate. They do want inflation to go higher, and in fact, the Fed has hinted several times that a little bit of an overshoot of inflation above its target wouldn't affect it. So I don't think central banks react very aggressively to inflation moving towards target and maybe slightly above target. But that at the same time, that's a worry for markets. If central banks accommodate this rising inflation, perhaps we get an overshoot and they have to come down aggressively later on. So in 2018, don't think central banks react aggressively. We still get the 3 hikes from the Fed, maybe 4. The concern is further out. We're getting late in the business cycle, and what central banks do in 2019 and 2020 is getting to be a concern.
We talked about rate hikes there. What about the balance sheet normalization at the Fed? Do you think that's having a big impact on the market?
That's having an impact on the market right now. I think what the market's focused on, rightly, is frankly neither so much the rate hikes or the balance sheet reduction. Is the combination of those with the huge fiscal deficits that we see coming down the pipe. So, the central bank's going to buy, the Fed's going to buy, $200 billion less of treasuries than it did last year. At the same time, the U.S. Treasury is going to issue $400 or $500 billion more of U.S. Treasuries. So what the market's going through right now is, with all of this excess supply, what is the clearing level? What are the yields where demand equals supply? So the market's concerned about the Fed, but it's exacerbated by the fact that we're significantly increasing our fiscal deficits and Treasury supply.
Let's look at what this could mean for investors. On the inflation front, does it make sense to have an allocation to an explicit inflation protection, something like TIPS, or do those look expensive today?
No, I think an explicit allocation either to TIPS or even to commodities makes sense today. So TIPS are pricing about 2.1% per year for the next 10 years, which given our base case and the risks to the upside, looks fairly attractive. It's not as attractive as 3 months ago when the market was pricing 1.9, 1.8% per year for the next 10 years, but they're still attractive, especially as in the Treasury market, TIPS at the end of the day are U.S. Treasuries, full faith and credit. In the Treasury market, there's going to be a bit of a supply-demand imbalance in favor of TIPS. We've told you, the Treasuries told us, we expect supply to go up by $400 or $500 billion this year relative to last year. And as of now, none of that increase is going to be in TIPS for the next several months. Sure, as Treasury supply goes up and fiscal deficits are here, TIPS supply is going to go up too. But for the next 6 months or so, all of the extra supply is going to be in regular nominal Treasuries and none of that in TIPS. So, you've got something favoring TIPS. And then commodities, we know, historically, commodities do well in the late stages of an expansion as supply bottlenecks fail to keep up with demand growth. And moreover, the crude oil curve is in backwardation right now. So if nothing changes, you make 8 to 10% per year just owning crude oil futures. So both TIPS and commodities seem to be attractive investments right now.
Looking at the diversification benefits of those nominal bonds, we saw this last week that bonds and stocks were kind of trading together. Does that, you think, a sign that we might not see the diversification benefits, or there's still a case to hold those long-term government bonds?
No, there's a strong case to hold long-term government bonds. I do caution that some of the correlations and historical relationships that we've seen over the last few years and that lots of people depend on may not be as reliable over short-term horizons. But if there's an event, if there's a recession, if there's a hit to equity earnings, if there's a geopolitical event and stocks are going down, for sure bonds will be going up at that time. So the defensive diversification benefits of treasuries and government bonds isn't diminished. What's changed is, so as a tail risk hedge, on the tails, when you get an event, when you get a bad event for something that's bad for the economy, bonds will do well and stocks will do poorly. So there's no change to that. It's around the middle of the distribution, like I said, where volatility is going up and central banks are buying less bonds, yields are slowly rising. In this slowly rising yield environment, it starts hurting the discount factor and hurting valuations on equities. So to put it again, in a normal environment, if bond yields go up, you could see stocks going down at the same time as bond yields go up. But in the big picture, as a defensive risk-off hedge, bonds haven't lost their value at all.
And finally, I did want to touch briefly here on equities and where you see the stock market today. With some of the volatility we've seen and a little bit of a sell-off here, where do you see valuations?
So valuations where we are for the S&P, 2650, the forward PEs are obviously come down, given compared to its peak at 2850. So 2018, 2019 PEs are around 17 or 18. I think that's reasonable. So the stock market is reasonably priced. It's just that we need to work through this volatility of either people overpositioned in the stock market, people expecting low volatility forever, this volatility around finding a new clearing yield for bonds, given all the excess supply that we're going to see. We need to work through all of these issues, which should lead to some medium-term volatility. But for long-term investors, 2650 on the S&P, I think it's a fine level to be invested.
Mihir, we really appreciate you taking the time today.
Thanks a lot, Jeremy.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.
Go from one investment analyst to 150. Sign up today for Morningstar Premium and let our independent and unbiased research staff help you find the best investments. Get started today with Morningstar Premium.
Next, Schwab's Liz Ann Sonders gives her take on the market's moves.
For Morningstar, I'm Jeremy Glazer. I'm joined today by Liz Ann Sonders. She's the Chief Investment Strategist at Charles Schwab. We're going to talk a little bit about what's been happening over the last couple of days. Liz Ann, we really appreciate you taking the time today.
Thanks for having me.
Let's start by just putting what happened in Monday and also last week into context. There's been some scary headlines out there, but historically, is this really all that bad?
Well, so yes, I actually think many of the headlines were a bit irresponsible and certainly hyperbolic with, largest decline for the Dow in history. Yes, that is factually true from a point perspective, but it barely makes it in the top 100 on a percentage basis in the S&P 500, which is arguably a better index. It was the 138th worst single-day decline. So I think a little context is important. Not to suggest that this isn't painful, but I think the headlines were a bit hyperbolic.
Let's look at potentially what was driving some of this moves. Kind of the conventional wisdom is that it was about potentially interest rates going higher. Does that ring true to you, or do you think that this was more a valuation-driven event?
So I don't think it was so much valuation-driven. I think fundamentals did drive the early part of this, and the more economic fundamentals would be the spike we saw in wage growth to 2.9% for average hourly earnings on a year-over-year basis. That caused a spike up in the 10-year Treasury yield, broke through 2.8% on the upside, inflation expectations kicking in. And I think that was the more economically driven kicker. But then I think the other kicker was less technical but more sentiment-based. We because of how low the volatility was last year, 3% maximum drawdown, second lowest year of volatility, on that metric in history. And if you look back at years past when you've had really, really low drama years, they tend to be followed by high drama years, even if you ultimately still have decent returns. And with that low drama year last year and strong returns, enthusiasm just kind of went off the charts. Most attitudinal measures of sentiment got to all-time record high levels of optimism. So I just don't think you had a lot of room for error. But then as the sell-off worsened, and in particular what happened yesterday, was less about the magnitude of the decline in percentage or point terms and more about the spike in volatility. And that spike in the VIX triggered a lot of forced selling of some of these positions tied to low volatility, and so it was a market structure thing more than anything else.
When you look at the fundamentals of the economy, do you see anything that shows that there is potentially some trouble on the horizon, or will this be more of an isolated kind of structural market event?
Well, again, yes, we did see a change in the characteristic this year with that pickup in wage growth, the rising inflation expectations, the expectations for tighter monetary policy, the likelihood of an uptick from what has been record low levels of financial stress. So the financial conditions, even though the Fed has been raising interest rates for 2+ years, financial conditions have never been as easy as they have been until recently. The stock market is a feeder into that, so I would expect to see financial conditions worsen a little bit here. So yeah, it's been our view that the flavor of the background fundamental environment was changing this year. We're later in the cycle. That means higher inflation, tighter monetary policy. That adds to volatility, puts some downward pressure on valuations. So I do think there has been a fundamental shift. What I don't think this represents is the beginning of the end for the bull market, i.e., I think the next true bear market will be one that is more traditional in nature and comes when the market starts to sniff out the next recession. And I don't think that's in the near-term cards, but we may have more technical damage to come.
Looking at that potential for tighter monetary policy, as Powell takes over the reins of the Fed, what do you think is going to happen with rates in 2018?
So we've had the view that 3 rate hikes is the base case for this year, and I don't know that I would suggest we're changing our view as a function of this. Now, in the immediate aftermath of last Friday's jobs report, when we saw that hotter wage number, you did see a quick spike in expectations for maybe 4 rate hikes this year, and I think that was a little bit of a spook factor for the market. Since that time, actually, though, we've seen a ratcheting down of those expectations. In fact, the Fed Funds futures market now doesn't even really have 3 as the base case. A lot can happen even between now and the March meeting, let alone the rest of this year. So I think trying to game exactly how many rate hikes would happen is a bit of a silly exercise at this point, because it is data dependent, but also to some degree probably a function of market volatility to a lesser degree anyway. So, but I think that a faster pace of rate increases is in the cards, but it's not just rate increases. The Fed is draining its balance sheet right now, too. So we have another form of tightening in the form of quantitative tightening. And I think the liquidity coming out that is represented by that, I think that's a factor that's not getting maybe the attention that it deserves.
Sam, we really appreciate you taking the time and sharing your insights on the market today.
Thanks for having me.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.
No matter what part of the market you're targeting, Morningstar Premium Screeners are your shortcut to finding the best investments. Get started today with Morningstar Premium.
And lastly this week, our analysts give 2 dividend ETF picks and stocks that look attractive after the energy sell-off.
Vanguard Dividend Appreciation ETF, VIG, and Vanguard High Dividend Yield ETF, VYM, are among the cheapest dividend-oriented funds available. VIG earns a Morningstar analyst rating of gold, while VYM earns a Morningstar analyst rating of silver. The primary difference between the funds is that VIG targets dividend growth, while VYM targets high dividend yield. VIG targets stocks that have raised dividend payments for at least 10 consecutive years and applies a profitability screen to avoid stocks that may be at risk of cutting their dividend payment. To further mitigate risk, VIG weights its holdings by their market capitalization and capped single stock weightings to 4% of its portfolio. On the other hand, VYM targets the highest yielding half of U.S. stocks. Like VIG, it market cap weights its holdings and reduces risk by owning a broadly diversified portfolio. VYM holds about 400 names compared to VIG's 180 holdings. As of December 31, 2017, VYM's dividend yield measured 3% compared to 1.9% for VIG. But don't be too put off by VIG's lower dividend yield. This fund earns a Morningstar analyst rating one notch above that of VYM because of its risk mitigation approach. For example, VIG dropped ConocoPhillips stock from its portfolio before ConocoPhillips cut its dividend payment in early 2016, presumably because it didn't pass VIG's profitability screen, while VYM still owned ConocoPhillips through its dividend cut. VIG's higher quality portfolio helped during the bear market from October 2007 to March 2009. VIG lost 46% over this time period, while VYM experienced a 57% drawdown. Both funds are excellent choices for investors seeking dividend-oriented strategies. Informed investors will understand that the primary difference between both funds is how they balance the trade-off between dividend yield and risk.
For Morningstar, I'm Jeremy Glazer. The energy sector has been hit particularly hard during the sell-off, and I'm here with David Meats, who's a senior equity analyst, for his take on why that could be happening. David, thanks for joining me.
Of course.
So it's impossible to ever point to one particular issue of what's driving an entire sector. But what do you think some of the factors are behind the sell-off?
Well, there's a pretty strong rally in oil prices in the last 6 months. WTI went from probably $45 to $65 since June of last year. And I think there's really a false sense of security in oil markets caused by the OPEC production cuts and by the disappointing growth from U.S. shale last year. U.S. shale last year was expected to grow much more robustly than it actually did. Volumes were stagnated during the middle of the year, and I think that with the most recent data suggesting that surge is finally coming, that gives investors the realization that that maybe the current tightness in oil markets is more temporary than they were perhaps thinking.
So one of the big drivers here really is just that the price of oil is falling here, or could be.
Yeah, essentially, you had a lot of issues in oil markets recently. There's potential for further sanctions on Iran, which were waived in January, but you have a 120-day window. Maybe that's something that gets revisited later in the year. And you have a huge output decline in Venezuela, which is very positive for oil prices, but I think that investors are really assuming the worst case scenario for production this year, so on the supply side, and that actually sets us up for some potential oversupply in the back half of the year. So I think it's definitely oil price focused. I think that the rally that we did see in the last 6 months was not really justified, and I think that we're seeing a correction to adjust for that.
So let's take a look at where that leaves us in terms of valuations. Even after the sell-off, are you seeing value across energy? Are the places that look more attractive, less attractive?
I think there are pockets of value. Where obviously stocks are correlated with energy prices, so a bearish outlook like we have for oil prices is not great for sector valuations. But in certain particular cases, there are opportunities. I would point to the shale-focused companies at the very bottom of the cost curve that can still thrive in an environment with crude prices in the $50 or $55 a barrel range. In particular, we like RSP Permian and Diamondback Energy. Both of those companies have very high-quality acreage. We kind of call it quote-unquote tier one, right in the core of the play where the well productivity is the highest, which gives you the best bang for the buck in terms of the returns. So we like the shale-focused companies at the bottom of the cost curve, and I would also point to the midstream industry just because it's not levered to oil prices because the contracts are fee-based. So we would again, as we favor the Permian Basin as the main growth engine for shale, I would point to Enterprise Product Partners and Plains All American Pipeline as companies that are positioned to capitalize on that Permian growth.
David, thanks for the update on energy today and for those ideas.
You bet.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.
That does it for this week's Investing Insights podcast from Morningstar.com. We hope you have enjoyed our program, and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening.